So, as you know, in our orange trading system, we do five kinds of analysis: liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. And in that particular order, you also know that there are four different market conditions. Currently, as I speak, the market is in uptrend under pressure. To help you understand these four market conditions, I have drawn this diagram. Basically, a confirmed uptrend means overall the stock market is going up. Confirmed downtrend means overall the stock market is going down. Uptrend under pressure means this overall the stock market is trying to fall from the top. And a rally attempt means the broader market is trying to make an attempt to rally up from the bottom. So uptrend means going up, downtrend means going down, uptrend under pressure means falling from the top, and rally attempt means rising from the bottom. This is the easiest way to remember market conditions. Why is this important? This is important because once you understand this, you really don't need to watch any business news. You don't need to subscribe to any new business newspaper or things like that, because there is too much information available online in the media or in the print media. This overall summarizes everything for you, because once you understand the market condition, you know what to do in what market condition. You can objectively define rules based on what you see as the current market condition. If the president of United States continuously keeps changing his trade policy, that is not a variable that you can use in your trading, but this is something that you can objectively use in your trading. One point I would like to mention here is that these four market conditions are derived from the movement of the Nifty. If you read carefully the MarketSmith website, they come up with these four options, but they derive these based on the movement of the Nifty. We will not go into the mathematics. If you want to check the details, you could either go to ChatGPT and ask about this with respect to how MarketSmith creates them. You can learn that for yourself. But without getting into the mathematics and keeping the discussion at a broader level, I wanted to discuss this. So it is not very accurate because it only comes from the movement of the Nifty 50. I don't know, they could have updated their calculation process, but as far as I understand, mainly coming from Nifty 50 index. I have seen that the CNX 500 or the Nifty 500 index is a much better representation of the Indian stock market, because it represents almost 96 to 97% market capitalization of Indian stock market. So if you go to ChatGPT and you ask ChatGPT, please explain to me CNX 500, it will give you all the information. It will tell you that 96 to 97% of the total market capitalization of India is in the top 500 stocks. The top 500 consists of 100 large cap stocks, which is Nifty 50 and Nifty Next 50. Then you have 150 stocks, which are mid cap stocks. So that's 100 large caps plus 150 mid caps. That's 250. And then below that, you have 250 small caps. Below that, you have micro caps. Okay, there's a lot of companies there. There are thousands of companies. There are more than 5,500 companies in India in the listed space. Bombay Stock Exchange and National Stock Exchange combined. I don't trade stocks which are purely on Bombay Stock Exchange. I stick to National Stock Exchange just for filtering purpose. You don't need too many stocks to buy. So why not go only with stocks which are traded on the National Stock Exchange? They could be traded on BSE, that is not a problem. But if a stock is only on BSE, but not on NSE, I don't want to go there because of liquidity reasons. Coming back to the market conditions. The market conditions get updated on this page. So I go here, you go to Market Smith. You know, by the way, all this, okay? You go to Market Smith, this is the home page. Scroll down, see, they say market is uptrend under pressure. I have not logged in. So this is free information. Then you click view more. See, this is also free information. Currently, you see orange color, the market is uptrend under pressure since 18th of July. As I record this video, today is Independence Day, 15th of August. Happy Independence Day to all of you. So as of today, it is uptrend under pressure, right? What have we discussed before? What type of trade should you be taking in these market conditions and why? That is very important because people want to know what to do. People don't know why to do it. So I always say that confirmed downtrend, no fresh positions, no swing trade, no positional trade. Why? Well, the answer is very simple. Overall, broadly, the market is coming down. So you could see exceptions. There were some stocks recently which shot up very fast, even though the market was under pressure. So you could see one or two exceptions here and there, stocks going up, which might make you feel the fear of missing out. But that is really not the case. When the market is in an uptrend under pressure or confirmed downtrend or rally attempt, overall on a broader basis, the market is coming down. Okay, so confirmed downtrend, overall stocks are falling, which means fresh position should not be taken. No swing, no positional trade. It's very, very simple. Why? Because we don't want our stop losses to get hit. Then comes confirmed uptrend. Overall, broader basis, the market is going up. So, which means swing, positional, everything is going up. Like November 20, like 2023 end, that was a very strong, healthy market. Everything was going up, right? Then comes uptrend under pressure. In confirmed uptrend, you would go with swing and positional because everything is going up. You would even find fundamentally weak stocks going up. So you don't want to miss out on those opportunities. So you understand why to avoid fresh positions when the market is in a confirmed downtrend. It's because 3 out of 4 stocks will fall when the overall market is falling because people are selling, people are exiting from the market, people are afraid, they are in panic mode. We don't want to be caught in that panic mode. Confirmed uptrend means people are euphoric. People continue to make purchases. Fresh money is coming into the market. So we want to participate in that. Now comes uptrend under pressure. Here, uh, I say that only go for positional, don't go for swing trades. Why? Because you need to understand the difference between a swing stock and a positional stock. The difference comes in terms of fundamentals. Well, if the market overall is falling, how can you expect a fundamentally weak stock to go up? What is the reason for a fundamentally weak stock to go up? Right? So if the overall market is falling, people will try to see in their portfolio which are the stocks that are fundamentally strong, which are the stocks that are fundamentally weak. So they might want to cut fundamentally weak positions first. They might want to keep fundamentally strong stocks in their portfolio. So in uptrend under pressure, stocks that are fundamentally strong might not fall. They might form a base, but they might not fall as aggressively as the fundamentally weak stocks that are, especially the fundamentally weak stocks that have already shot up beyond their earnings. They have already shot up more than they should have gone up, right? That is the reason why when the market comes under pressure, it is very risky to stay in stocks that are fundamentally weak because the market knows that this stock is fundamentally weak and the price has gone up way beyond what the earnings justify. So they will first cut their positions to book the profit that they have made. That is why in uptrend under pressure, why to take a swing trade and take a risk, right? That is why only positional stocks in uptrend under pressure. Rally attempt, well, again, why would you buy a swing stock? Why would you buy a stock which is fundamentally weak? Because you still don't have confirmation. The market condition itself is called rally attempt. It is not a confirmed uptrend. The market is attempting to rally, but let it come in a confirmed uptrend. Wait before you start buying stocks that are fundamentally weak, right? Rally attempt could be made by stocks that are fundamentally strong. The market would first prefer to buy stocks that are strong. They have strong balance sheet, good fundamentals. Market will first prefer to buy them. Those are the stocks that will first push the industry and the market up, and then the swing stocks would follow. I am talking on a broad general basis what is likely to happen in the market. That is why only positional stocks in rally attempt with small position size. Why small position size? Because there is no confirmation. It has started to make an attempt to rally. It has not succeeded in that attempt. That is why small position. Uptrend under pressure, normal position. Why normal position? Why not half position? Well, because in uptrend under pressure, that could be temporary, right? The market could again rebound to confirmed uptrend, plus fundamentally strong stocks which have not run up too much, like fundamentally strong stocks which are not in base 4, base 5. If they are in the early stage, they might not fall as much. So why to take small position? And anyways, the market has given profits to people before coming into uptrend under pressure. So there is less likely to be a lot of selling pressure. Here in rally attempt, there could be overhead supply from the left side of the chart. You understand what I'm saying? So there is logic that I am using here. This is timeless logic. This does not depend on what Donald Trump is doing or what is happening in the Indian economy or the European economy or whatever is happening in the world. Okay, everything gets summarized in the indices, and from the indices come these market conditions. And I have developed a system, my own system, to identify whether the market will come under pressure by looking at the number of stocks that show up in my filter. So if I go to the breakout, see, this is my evergreen filter. Let me log in. So this is my evergreen filter. Okay. So I track the number of stocks that show up here. See, now it's showing 69 stocks. So if I track this number daily, if the number is decreasing, what does that mean? It means that the overall broad basis, the stocks are declining, right? You might see in this list one or two stocks shoot up, and you might feel that, oh, I missed the stock, but that is not the case. If you had bought that stock, along with that stock, you could have bought other stocks as well, which were not completely in sync with our criteria. You fail to realize that when you're looking at a stock that has shot up, right? And if you feel fear of missing out, then you are failing to realize that if you had bought that stock, which was not fully in sync with our criteria, you would have bought 10 other stocks which looked like that stock, and 9 out of 10 of those would have gone down, and one of the stock would have gone up. Overall net you could have ended up losing money. That is what you do not realize, because when you relax your criteria and buy a stock, you will have to buy other stocks that come into that criteria, right? Because you never know which stock out of those 5 or 10 are going to go up. So with every winner that you buy, you will also have a handful of losers. That is the reason why I am very strict with my criteria, right? You have to think in terms of probabilities. You cannot think in terms of one particular stock. I see a lot of students, they look at a stock and they feel that, oh, I should have bought this stock at that particular level. Well, you never know. You did not know that the stock was going up. And if you had bought the stock, along with that stock, you could have bought other stocks as well. And you don't know what those stocks would have done, right? So you have to think like a professional trader. If you are looking at a chart which is going up, and if you feel the fear of missing out, you are not you are not a professional trader. You are not a professional stock market trader. Okay, that is not how trading works. So I track this number, and I have developed a system where, almost 2 weeks or 1 month before in advance, I get to know that the market is likely to come under pressure before even this status changes. So this status changed on 18th of July. But as far as I remember, back in June itself, mid June or later part of June, I quickly began to realize that although they show confirmed uptrend, the market is coming under pressure because this is representing the Nifty movement, right? You see this Nifty is in an uptrend. Now, Nifty, I don't know, they are talking about Nifty 500, CNX 500, or they are talking about Nifty 50. I suppose they are talking about Nifty 50 because they consider that as a proxy to the Indian stock market. I don't know. They have the right to change their calculations, but as far as I understand, it's Nifty 50. So before even the Nifty 50 changes direction, you can see broad based weakness coming into the market, which can be captured by this filter. So 18 July, what 18 July? June itself, I was becoming aware that there is something wrong in this market. The market was in a confirmed uptrend, but I was not getting a basis. And even if I was getting basis, I was not getting a base in a fundamentally strong stock. So weak stocks were forming base. There was something odd about the market. And I realized that maybe the market will change direction. And finally one day on 18th of July, they ended up changing the direction. So if you track this number on a daily basis, you pretty much get a feel of what the market is likely to do. You don't even need to check whether the market is in a confirmed uptrend under pressure, downtrend, or rally attempt, right? But this is a very objective way of looking at market condition. And by the way, why do we look at market conditions? What is the need to look at market conditions? Because you want to answer two questions. Number one, should you buy in this market or not? And if yes, what should you buy, swing stock or a positional stock? And number two, position size. How will you decide what position size you should take? If the market is in a rally attempt, will you go in with a full position size? Where it's very risky, because if you go in with like 20-25% position size, the market is trying to attempt a rally. What if the attempt fails? You quickly begin to lose money, or stop losses might get hit, right? That is the reason why, to first understand whether we should buy or not, and secondly, how much position size should we start entering with. These are the two most important questions. And if you ignore market conditions, you are certain to lose money, right? Because the market has a huge impact on individual stocks. Thank you so much.